Hey, welcome back everyone. So my name is Zach Vines, and what we're going to go over today is the flow of the financial statements in our Fundamentals of Accounting courses. So when we're first beginning, we'll have to fill out things like a balance sheet, or you'll hear things like an income statement. And it seems to get lost in translation when we're first beginning these classes, that there's actually a really intuitive flow throughout these statements where you have to go in a certain order because the information you get from one statement funnels into the next statement, which goes into the next statement, and so on and so forth. And so I want to show you what that flow looks like. Just as an overview to start with, the overall financial statements and the order that you go in starts with your income statement, which goes into your statement of stockholders' equity, which goes into your balance sheet, and finally you finish up with the statement of cash flows. So we'll get into that in just a moment, but to start with, I want to show you how we set the field in order to have all of our numbers laid out so we can just properly plug into those statements. And so most of the work we're doing, most of the error that you could possibly have as far as your numbers are concerned is going to happen right here. So this is what you need to do first before we start flowing into the financial statements. So let's talk about that first. To start with, we have our journal entries. So in our accounting debit credit tutorial video, it would just be we have a transaction and we pay cash and we receive a service. So we debit an expense and credit cash. And it's just a bunch of different specific transactions that happen. They're very case by case, but it's pretty much debit this, credit that, and you do that for every single transaction, okay? So you go through your list of transactions, debit and credit all of them properly, and you move on to your T accounts. So T accounts are extremely helpful in accounting because they show you on an account by account basis what you began with in that account, all of the changes that made it go up and down, and eventually what your ending balance is in that account. And so, for example, we have our cash account right here, where it starts off with just some number in their beginning balance. So we're assuming this isn't our first year of business. We're rolling over whatever our cash account was from last year, and we begin with some debited amount. And then certain things happen throughout the year based off of our journal entries. Maybe we pay for something in cash, and so we credit cash, and then we earn more cash, so we debit cash, and we debit credit, debit credit. You end up lumping those together into your overall ending balance. And that's going to be really important, especially as we get into the balance sheet. But you pretty much do this for every single account. Go into your journal entry. If you debited cash, go into cash and put a mark on the debit side. If you credited cash, go into the credit side and credit cash. And you do that for every single account so that you can see what you began with, all the changes that happen throughout the year, and then finally what you end with. So once you do all of your journal entries, which funnel into your T accounts, you then make your trial balance, which is essentially a giant T account that just has all of our debits on the left, all of our credits on the right. And by debits and credits, I mean the ending balance in these accounts right here. And it's called a trial balance. So we're looking at the overall ending balance in that account. And we're just making sure that all of our debits match all of our credits, because if that's not the case, then you certainly did something wrong on the journal entry level, which should prompt you to go back to the actual journal entries themselves, double check them, make sure you didn't over debit or over credit something. All of them need to match up. And once all of that is set up, we can actually go into the financial statements, which we'll do right now. Okay, so first we're going to talk about the income statement. So what I want you to think about as we get into each of these statements, first ask yourself, what is the name of this statement? The name of the statement is going to directly give away what all is involved with the statement. So instead of just arbitrarily memorizing what all goes into each of these statements, ask yourself, what is the purpose? What am I trying to find right here? And then it becomes much more intuitive. And so when we're dealing with the income statement first, what's the name of the statement? Well, it's the income statement. So they're probably wondering about net income, right? And what was net income again? We have our revenues minus your expenses equals your net income, right? So if we're wondering what our net income is, odds are we're going to take into account all of our revenues, all of our expenses, which will equal our net income. So one thing I want to emphasize is that I'm not going to be so much going over how to fill out each of these statements as much as I am demonstrating why we do these statements in the order we do them in. And so what I'm showing you right here is more of a single step income statement, which just tallies up all your revenues, all your expenses, and puts it into net income. In real life, most of the time, we're going to use a multi-step income statement, which is designated for the same purpose. It's supposed to tell you what your net income is, but it provides various subtotals throughout the income statement that are just useful to look at for ratio analysis and just operational purposes. Looking at certain subtotals can give you certain indicators about how your business is running, certain efficiencies that you could provide and everything like that. But just overall, you can think of the income statement as just providing your net income, which is going to lead us into the statement of stockholders' equity. Okay, so for the statement of stockholders' equity, we again are going to ask ourselves, what is the name of the statement? What is this intended to show us? They say stockholders' equity, right? What does that sound familiar? Well, one of the first things we learn in accounting is the accounting equation, right? Where we have our assets equals our liabilities plus our stockholders' equity. And stockholders' equity was comprised of two things. We had our common stock and our retained earnings, right? So if we're wondering what is the balance in our stockholders' equity, which is the purpose of the statement of stockholders' equity, not surprisingly, we're just going to take into account all the things that affect our stockholders' equity. So those things would be like common stock, which is a component of it. So you start off with some amount in your stockholders' equity, then you add in any common stock that you issued. So we have specific columns right here to kind of represent the different things that increase it and decrease it, so we can keep track of those individually as well. But the common stock is going to increase your overall stockholders' equity. So we have common stock increase, your total stockholders' equity will increase here. Then the reason, again, that we have to do the income statement first, because that funnels into your statement of stockholders' equity. You need that net income, or it could be a net loss, in order to figure out what was the effect on your overall stockholders' equity throughout the year. So you plug in that net income that you just found out from the income statement right here. If it's income, that will increase your retained earnings. If it's a loss, it will decrease, and the same effect will happen on the total. And then the only other thing that's a little bit trickier that you don't necessarily see right here are dividends. So an important thing about dividends is that they are not considered an expense as far as net income is concerned. It's not revenues minus expenses and dividends equals net income. It's an entirely separate consideration, even though it has the exact same effect on our retained earnings as an expense would, because when expenses go up, that decreases your net income, which in turn decreases your stockholders' equity and your retained earnings. A dividend is just a totally separate line item we take care of individually, which pops up on our statement of stockholders' equity. And so you take that into account, that gives you all of your ending balances right here, and then we're ready to go on to the balance sheet. Okay, so as far as the balance sheet is concerned now that we've done our income statement, where the net income plugged into our statement of stockholders' equity, we have our statement of stockholders' equity, which gives us our ending balances and our common stock, retained earnings, and just our overall stockholders' equity. Now we're here for the balance sheet. So again, that same question, balance sheet. What is that talking about? What does that name indicate to you? It's a sheet that's telling us a lot of the balances we have. Balances in what? All of those accounts that we had the T accounts for, right? Where we had the beginning balances, all the changes that happened, and then the ending balances, because the balance sheet is going to tell you the balance in those accounts at a specific point in time. And the point in time we're talking about here are those ending balances. And so again, like I said before, as far as the T accounts and the journal entries are concerned, that's really the area where you could mess up numerically. Everything else is just plugging what you already did right there into the various statements. So the balance sheet is going to break up. You pretty much think about it like your accounting equation. Your assets equal your liabilities plus your stockholders' equity. We have all of our assets, so cash, accounts receivable, etc. One thing I do want to point out is that as far as your liabilities and your assets are concerned, you want to order them from current down to non-current. So, your cash, that's as current as it gets. It's already cash. You don't turn it into cash. But things like, buildings and land and things like that, that's going to fall further down the assets, because those are non-current in nature. You have them for at least over a year. It's not something that you're turning over quickly. You're probably not buying and selling land willy-nilly. So you always want to order those from current to non-current. And there's a little bit of leeway as far as how strict your professor might be in putting, one account over another. But generally speaking, don't put cash below inventory or land or anything like that. And same goes with the liabilities. So we essentially have all of our assets listed out from the ending balances from our T accounts. Then we have our liabilities, accounts payable, wages payable, etc. Also, those are ordered current to non-current, and you're going to get those ending balances from your T account as well. Then your stockholders' equity. So this again starts to play into the flow of the financial statements. You can see that stockholders' equity has your retained earnings and your common stock and your overall stockholders' equity number. Well, our statement of stockholders' equity told us all of that. We have our ending balance in common stock that's going to funnel right into our statement of stockholders' equity. Same goes with your retained earnings. That plugs right in. And then your overall number you have should match up with that as well. So you even have your previous statements as a check figure you could use to make sure that you're doing it properly. So once you have your balance sheet all set up, the only statement we have left is the statement of cash flows. Okay, so now that we're on our statement of cash flows, so one more, again, we have a very specific flow we have to go in for these financial statements. So when we went from income statement to stockholders' equity to balance sheet, we all had things from those statements we needed for the next one. So you'll see that'll be the same case for the balance sheet right here. But in general, the statement of cash flows is just talking about what happened to your cash. So again, revenues and expenses are not synonymous with cash coming in and cash going out. Here we are literally talking about the physical green dollar bills that we are keeping track of. And there are various activities that those cash flows fall under. So we have operating activities, which is just things that happen in the normal course of your operations. We have investing activities, which is like purchasing, a long-term piece of equipment, some sort of long-term asset. And then a financing activity, that's just us financing our business. Either we issue common stock or we borrow money, we get a loan, things like that. And so for the statement of cash flows, we start off, and this is the indirect method. There are various methods you can use for your statement of cash flows, and we'll maybe get into that in a future video. But for right now, again, I'm just kind of showing you the flow of the financial statements. So we start off with our net income, which remember is accrual based, right? Like revenues, we could have revenue on account. We could pay for something as a payable on account, and that would go into your net income even though that wasn't the exact flow of the physical cash that went in and out the door. So what we do here is that we reconcile our accrual-based income to the actual cash that we have, and that should end up agreeing with our cash balance on the balance sheet. So overall we start off with our operating activities and these increases and decreases in these accounts. So I'll talk about depreciation for an example. Depreciation is a non-cash expense, right? Like that's just we bought a long-term asset, and instead of expensing it all at once and hitting a giant expense on our net income and making it look like we have incurred this huge expense that just tanks our net income, we allocate the benefit that we receive from that asset over a period of time by depreciating it. Oftentimes straight line depreciation, we just take the number, subtract the salvage value, divide it by the useful life, and we just depreciate it over time. Well, that's not cash that we're paying every year we depreciate that asset. That's just our way of allocating the expenses on an accrual basis. So what we do here is we start off with our net income and we go, okay, well, to get this number, we had to expense that depreciation, so it lowered us down to this number. But that's not a cash expense, so let's add that back so we can get back to our cash balance. Essentially, you see what the beginning and ending balances were in various accounts that impact your operating, investing, and financing activities, and you can use your balance sheet. So oftentimes you'll have a comparative balance sheet, which will show you, those are the balances in your accounts, usually as of the end of a fiscal year, like at a point in time. But you'll likely have the balance sheet for the previous period, and you can see what the increase or decrease was between those accounts from year to year. If you don't have a comparative balance sheet, then you still have your T accounts, which showed you what you began with in that account at the beginning of the year, and then you see what it was at the end of the year. Whether or not it increased or decreased, you plug into this appropriately. And again, it's very case by case as far as exactly what accounts you need to look for. The purpose of the video isn't explain how to write out a statement of cash flows, but more to just show you the flow of everything. So essentially, you label out all of your operating, investing, and financing activities based on the increases and decreases in certain accounts that impacted those activities. And you can base that off the T accounts. You can base them off the balance sheets, which entails why you need to do the balance sheet first so you can see what those increases and decreases were, so you can funnel them into your statement of cash flows. And by the time you get all of these figured out, that will be your net increase or decrease in cash, okay? So your operating, your investing, and your financing activities, lump all those together, and that's how your cash changed during the year. Well, you should have what your cash was at the beginning of the year, either based off of a comparative balance sheet from the previous year or your beginning balance in your T account. So if you can get your beginning balance, see all the increases and decreases that happen in your cash, it should give you the ending cash balance that you have on your balance sheet right there, because that is the ending balance as of that point in time. So that's pretty much the overall overview of how those financial statements flow. Again, I hope that you see it's very intuitive, and there's a very distinct reason we have to go in that order, because the information we get from previous financial statements funnels into the next one, and it'll help you if you could keep in mind the names of the statements as well. Instead of just memorizing what all goes into them, you can ask yourself, statement of cash flows, what does that involve? The changes in cash, the flows of cash. The balance sheet deals with balances at a point in time. Income statement is your net income, and so sort of memory tools that you can help remember like that. So I hope that helps out, and we'll see you in the next video.